Inflation, the gradual increase in the general price level of goods and services over time, is an economic phenomenon that significantly impacts your purchasing power. It's a concept that affects individuals, families, businesses, and governments alike, and understanding how it influences your ability to buy the things you need and want is crucial in making informed financial decisions. At its core, inflation erodes the real value of money. As prices rise, the purchasing power of your currency decreases. In other words, the same amount of money won't buy as much as it used to. This shift in purchasing power has wide-ranging implications, and in this discussion, we will explore the various ways in which inflation affects your everyday life and financial decisions. One of the most immediate and direct ways inflation affects your purchasing power is by reducing the value of your savings. Money that you've saved or invested, such as in a savings account, fixed deposit, or government bonds, can lose value over time as inflation outpaces the interest or returns you earn. Consider a simple example. If you have $10,000 in a savings account, earning a 1% annual interest rate while the inflation rate is 2%, the real value of your money is declining by 1% each year. After a few years, your purchasing power will diminish, and you'll be able to buy fewer goods and services with the same amount of money. Inflation also affects your ability to plan for the future, particularly for long-term goals like retirement. As the cost of living rises over time, the amount of money you need to maintain your desired lifestyle in retirement also increases. If you underestimate the impact of inflation, you might find yourself with insufficient funds to support your retirement needs. It's crucial to account for inflation when saving and investing for the long term. Inflation doesn't just impact your savings, it affects your daily expenses and the cost of living. When prices for essential goods and services like food, housing, healthcare, and transportation increase, your day-to-day spending habits must adapt. You might find yourself allocating a larger portion of your income to cover these rising costs, leaving less room for discretionary spending or saving. For example, if the price of gasoline increases due to inflation, you'll spend more on fuel for your car. As a result, you might have to cut back on other expenses or activities to balance your budget. Inflation can even push some individuals and families into financial hardship, especially if their income does not keep pace with rising costs. Inflation has a particularly pronounced impact on fixed-income individuals, such as retirees who rely on pension payments, Social Security, or fixed annuities as their primary source of income. These fixed-income sources do not typically adjust for inflation, meaning that their purchasing power declines over time. Retirees may find it increasingly challenging to cover their expenses as inflation erodes the real value of their fixed incomes. Furthermore, inflation can lead to uncertainty and financial instability. When prices are rising at a rapid pace, it becomes difficult to predict how much money you will need in the future. Businesses face challenges in pricing their products and services as the cost of raw materials and labor can fluctuate due to inflation. These uncertainties can lead to economic instability and make financial planning more complicated. The impact of inflation extends beyond individual consumers and households. Businesses must also navigate the effects of inflation on their operations. Rising costs, driven by inflation, can eat into a company's profit margins. To maintain profitability, businesses may need to increase the prices of their products and services, which, in turn, can be passed on to consumers. Inflation can also influence investment decisions. Investors often consider the impact of inflation on their portfolios when choosing where to put their money. Assets that have historically provided a hedge against inflation include real estate, commodities, and certain types of stocks. These investments may offer some protection against the eroding effects of inflation, helping to preserve your purchasing power over time. On the other hand, fixed-income investments, such as bonds, may be less attractive during periods of high inflation because the interest payments they provide may not keep up with rising prices. Investors may seek alternatives that offer better inflation-adjusted returns. Governments and central banks play a pivotal role in managing inflation. Central banks use monetary policy tools, such as interest rates and money supply, to control inflation. They aim to keep inflation at a target level, often around 2% in many developed economies. The goal is to strike a balance between promoting economic growth and stability while preventing inflation from eroding purchasing power too rapidly. In response to rising inflation, central banks may increase interest rates. Higher interest rates can make borrowing more expensive, which can reduce consumer spending and business investment. This, in turn, can help slow down inflation. However, higher interest rates can also have negative effects, such as reducing economic growth and potentially causing unemployment. Governments can also influence inflation through fiscal policies, such as taxation and government spending. For instance, an increase in government spending can stimulate economic activity and lead to higher inflation, while tax cuts can put more money in the hands of consumers, potentially increasing demand and prices. Balancing these policies is essential to achieving economic stability and controlling inflation. Inflation can impact international trade and exchange rates. When one country experiences higher inflation than its trading partners, its currency tends to weaken relative to other currencies. This can affect the terms of trade, making imports more expensive and exports more competitive. A weaker currency can also increase the cost of foreign travel and the purchase of foreign goods and services. Investors and businesses operating in international markets need to consider exchange rate risk when making decisions. Currency fluctuations can impact the profitability of international investments and transactions, and businesses may use strategies such as hedging to mitigate these risks. Inflation can create opportunities for certain investors and asset classes. For example, investing in stocks can be a way to potentially outpace inflation. Historically, the stock market has provided returns that exceed the rate of inflation over the long term. However, it's essential to remember that the stock market also comes with risks, and the performance of individual stocks can vary widely. Real estate is another asset class that can serve as a hedge against inflation. As property values and rental income tend to rise with inflation, real estate investments can provide a relatively stable source of income and a potential store of value. Commodities such as gold and oil often perform well during periods of high inflation. These tangible assets can be a way to preserve wealth when the value of paper currency is declining. Gold, in particular, has been a traditional store of value and a hedge against inflation. Inflation-protected securities, like Treasury inflation-protected securities, TIPS in the United States, are government bonds designed to provide investors with protection against inflation. The principal value of these bonds adjusts with changes in the Consumer Price Index, CPI, ensuring that the purchasing power of the investment is maintained. When it comes to personal financial planning, it's important to be aware of the effects of inflation on your investments and savings. Diversifying your portfolio across different asset classes can help protect your purchasing power in the face of inflation. Consultation with a financial advisor can be valuable in developing a strategy that aligns with your financial goals and risk tolerance. One of the ways governments and central banks track inflation is through various economic indicators. The Consumer Price Index, CPI, and the Producer Price Index, PPI, are two common measures used to monitor price changes in an economy. The CPI focuses on the prices paid by consumers for a basket of goods and services, while the PPI tracks changes in the prices of goods and services at the wholesale level. The core CPI excludes volatile items like food and energy and provides a more stable measure of underlying inflation. Central banks often use these indicators to assess the state of inflation in the economy and make decisions regarding monetary policy. Hyperinflation is an extreme form of inflation characterized by very rapid and typically out-of-control price increases. This condition can lead to the near collapse of a country's currency, with prices rising so quickly that they may change several times in a single day. Hyperinflation is often caused by a combination of factors, including excessive money printing, loss of confidence in the currency, and economic instability. Hyperinflation has devastating consequences for an economy and its citizens. It can wipe out savings, disrupt economic activity, and lead to social and political unrest. The most famous historical example of hyperinflation is the Weimar Republic in Germany during the early 1920s, when people needed wheelbarrows of cash just to buy basic goods. In summary, inflation is a complex economic phenomenon with widespread implications for individuals, businesses, and governments. It erodes the purchasing power of money, making it essential to understand its impact on your financial well-being. To navigate the effects of inflation effectively, you must consider how it affects your savings, expenses, investments, and long-term financial goals. Diversifying your investments, staying informed about economic indicators, and working with financial professionals can help you preserve your purchasing power in the face of inflation's relentless march. It's a fundamental aspect of modern economics that influences nearly every aspect of your financial life, and its effects must be considered when making decisions about saving, investing, and spending.